So I showed you 3 different ways of looking at this. You've got the recession buy indicator, what happens when the stock market enters a 20% bear market, and what happens after 2 big quarter drops. All the odds are heavily in our favor. Hey guys, Omar Khan here from Theta Trading, and I hope you guys are enjoying the videos we're creating. We put a lot of effort and work into these videos. I really hope you guys are enjoying them. If you can hit that like button, hit that subscribe button, and leave some comments. What do you want to see in future videos? I want to create videos that people want to see. We want to promote our strategy and our way of thinking because I think it's the best investment strategy out there. If you don't know what our strategy is, take a look at our previous videos. It says, what is the Theta strategy? In my opinion, it is the best strategy out there. It gave me my financial freedom, and I hope it does the same for you. All right, so today's topic of conversation, is there more pain to come in the stock market? Well, the simple answer is nobody but nobody knows. In the short term, the stock market is a popularity contest. Long run, it's a weighing machine based upon earnings, how much money companies make. So nobody knows if the market's going to go lower or higher in the next little while. But we know it's taken a pretty bad beating. So let's take a look at what the evidence tells us. All right, so here's the first thing. Those who buy in the stocks, the day the S&P 500 enters a bear market, have made an average of 22.7% over the following 12 months. Those are some pretty good odds, right? So the markets have, the S&P 500 is down 24% at its low point. Now it's around 21%. So we are definitely in bear market territory. But look what this tells us. A shrewd contrarian strategy is to buy when the markets drop 20%. As the old saying goes, when others are fearful, be greedy, and when others are greedy, be fearful. There is a lot of fear out there right now. This is when you want to be opportunistic. All right, so let's take a look at this number a bit more, 22.7%. What does that mean? In every bear market since World War II, if you bought stocks on the day the S&P 500 closes below the 20% loss threshold, sometimes that day came near the end of the bear market. In other cases, the market continued falling. That's why I'm saying nobody knows how close we are to the bottom before eventually turning up. But on average, you would have done pretty well. And you wouldn't have had to wait all that long either. Your average total return would have been 22.7. That's more than double the stock market's long-term average. So you can see the stock market on average has returned just shy of 11% over the last 60 years or so. But that is, you can historically double that return based upon the markets going down 20%. Those are some pretty good statistics, some good odds that are in our favor. All right, so now the word of the day is recession. Are we in a recession? How bad is this recession going to get? When will it be over? Again, nobody knows. But I would hazard a guess we are probably in a recession. So if it is a recession, buy. This little known market indicator is telling you to scoop up stocks on the cheap. Now there's something called the recession buy indicator. It's a contrarian measure, and it's been right more often than it's been wrong. Now, a recession is something that we may be in right now, and I'll give you the definition of it, but this recession buy indicator has been a pretty decent indicator of how people do long term, okay? So let's take a look at this. In the first quarter, U.S. GDP contracted, and most likely in the second quarter of this year. Okay, therefore satisfying the definition of recession, 2 quarters of economic contraction. Now, according to something called the recession buy indicator, a good time to buy stocks is when it first becomes obvious that the U.S. economy has been in a recession. That realization typically occurs around the 7th month of the downturn. So, this market started turning down at the beginning of this year, in 2022. So we are at the 7th month now here in July. Okay? Now, it says since the median U.S. recession lasts around 14 months, and given the stock market discounts its future value 6 to 9 months in advance, maybe even up to 12 months in advance, stocks not infrequently are bottoming around the same time that the news headlines are heralding that the economy is in a recession. You guys have probably seen the news, recession. It's everywhere. But that is the time historically when, if you had bought, you had done pretty well historically. Now, what are the concerns of today, and are they different from yesterday's concerns? Well, the concerns of today are inflation, Okay, that's the big concern. You see it at the grocery stores, you see it at the gas station, you see pump prices up, cost of goods up, all these prices are up. So what's happening is, because in 2020, because of COVID, the banks around the world, central banks, the Federal Reserve and other banks, they had to print a lot of money to get us out of that crap. Okay? Otherwise, we would have fallen into a much, much worse recession. So they printed a lot of money. People spent. And now that it's rearing its ugly head in the form of inflation. Inflation is defined as too much money chasing too little goods and services. Now, I've done a couple videos on inflation recently to show you that inflation, commodity prices and whatnot, are starting to come down. And also, we always use the eyeball test here at Theta. You can probably see people that you know who are spending less. They're not going out as much. They're not traveling as much. They're not driving as much. These are all deflationary. So we're going to look for deflationary information coming out, deflationary data coming out in the near future. If we start to see that, the stock market is most likely going to like that a lot. It says, great, recession is nowhere near as bad, inflation is nowhere near as bad, and therefore we don't have to increase interest rates as much as we thought. And that's what's been happening. Interest rates have been going up, and that is how these central banks combat inflation. They raise interest rates so that people have more pain. For example, your mortgage payments go up, all the different payments go up, that your line of credit, all these things. If you own rental properties, those payments may go up if they're variable. And because of that, it slows the economy down. It slows everything down. And what that results in is lower consumption and thus lower inflation. But we haven't really seen any good inflationary data yet. But you can start seeing it with your eyes, like I said. You can start seeing, I noticed here in Toronto, Canada, that gas prices are coming down. Also, you can see the price of Brent, crude oil, West Texas Intermediate, it's all down. Commodity prices are coming down. There's a glut of inventory, which means you're probably going to get some big sales. Amazon's having 2 Prime Days this year, which means they bought a lot of stuff, and now they have to look at selling that stuff off at a discounted price because they have too much of it. Okay? And that is deflationary. That's what we're looking for, okay? So now, let's go to this next slide here. Going back to the recession indicator, okay? The accompanying chart shows the S&P's 500 average inflation-adjusted total return over 3, 6, and 12 months following these triggers, okay? So after the recession buy indicator signal goes on, okay, which we are in now, we can see what happens over 3 months in blue here, okay, over 6 months, and look at over 12 months. A nice return, okay? And this is all the way back to 1871. So there's a lot of data. The last data set we looked at was since World War II, or in the earlier slide. This goes back all the way to 1871. Now, you tell me something. Are the odds in our favor? Our job is to tilt odds and probabilities in our favor. Here, are the odds in our favor? Well, yes. And the old adage goes in the stock market, buy low, sell high. Right? And right now, we are getting some pretty phenomenal discounts. But as always, make sure that whatever company that you're investing in, you understand it thoroughly, you know it, you love it, and you believe it'll be worth more in the future. Now, here at Theta, I believe we have the best strategy out there. If you guys are not familiar with our strategy, I've done a video saying, what is the Theta strategy? Take a look at that and let us know what you think. What we do here is we agree to buy stocks and we get paid a lot of money for it. I know it sounds weird, but take a look at this at our video on what the Theta strategy is, and you'll have a good idea. What exactly is a Theta strategy, and why do I think it's the best strategy out there? Why do we believe it's the best strategy? Once you see it, the logic may resonate with you quite a bit. So, again, is there more pain to come in the stock market? Nobody knows, right? We're looking for good inflationary data. We're looking for less interest rate rises. But this tells us, okay, when the markets drop by 20% or the recession buy indicator goes on, the next 12 months have been historically very good, okay? Now let's take a look at one more chart here, okay? What happens when stocks have done really poorly after 2 big quarters, okay? So in the first quarter of this year, okay, Q1 of 2022 and Q2 of 2022, we have had a more than 20% drop in the S&P 500, okay? Now, this has happened a few times in history. You can see here, June 62, June 70, 74, 74, 02, 08, 09, and now here we are again, 22. Now, this doesn't include all of them because we did have another one in 2020 with COVID, but the market bounced back very, very strongly, okay? So if you have two consecutive quarters, in 2020, it did not drop two consecutive quarters, okay? So this is two consecutive quarter drops, okay? All right. The COVID correction was a very short, fast-lived correction. All right. So after two quarter drop, you can see that in black, right? You don't know where exactly the bottom is going to be. We're pretty good. We've dropped a lot so far. But look at the next quarter. On average, up 8.5%. The next half year, up 21.5%. And the next year, up 31.4%. And I know that every single time is different. I get it. Every single recession, every single scenario is different. But all we can do is what history tells us, right? History tells us that every time the market has dropped like this, it has done exceptionally well. Not every time, on average, it has done exceptionally well. 31.4%. Those odds are heavily in our favor. Now also remember, the markets, because human life keeps getting better, companies keep making more money. Every time the markets have dropped, they've always returned to an all-time high. Now, if you believe that to be the case, is there more pain to come in the stock market? Sorry to say, guys, nobody in this world knows the answer to that. If they did, they'd be the richest person in the world by far. Okay? Now, we're going to go and look at what history tells us. So I showed you three different ways of looking at this. Okay? You got the recession buy indicator. You got what happens when the stock market enters a 20% bear market, and what happens after two big quarter drops. All the odds are heavily in our favor. Okay? I hope you guys have liked this video. If you guys have any questions, comments, please put them below. Hit that like button. Hit that subscribe button. Please help us get to 1,000 subscribers. It would be greatly appreciated. And again, Omar Khan here from Theta Trading, and we'll see you next time.